In today's video, I'm going to be answering the question, can you afford this home on Zillow? Zillow is one of the most popular websites when it comes to searching for a home. I'm going to pick a random city and then we're going to dive into the numbers to figure out what does it truly take to purchase this home. And if this is the first time that you're checking out my channel, my name is Seanu Uyehara. I'm a branch manager with Loan Depot, helping you understand and get your mortgage right. It wasn't too long ago that I was just like you, looking to buy my first home, looking to buy an investment property, or figuring out how to manage my mortgage. And over my 17-year career, I wanted to give you all the information that I've been able to gather to help you get your mortgage right. We drop videos every single week, so if you like the content we're putting out, don't forget to subscribe and hit the bell so you get notified every single week when we put out more content. Now, before we hop into the video, I wanted to give a special shout out to our commenter of the week, Daniel Cabrialis. Daniel's question was, if I'm currently a student, but I'm about to graduate with a good paying job lined up and have only been working part-time for the past couple of years with a good credit score, what are my chances of getting approved for a loan? Daniel, that is a great question. Now, for all of you that are in school and going to school for a specific trade, we can actually use your schooling as part of your work history. So you don't necessarily need to be working full-time. We can use your education history in that specific program as part of your work history to qualify you for the mortgage. We see this quite often with those that are in the medical industry. So if you are going to a trade school or something that you're learning something specifically and you're looking to buy a house, don't get discouraged because we can use your education to help you qualify. So Daniel, great question, and we hope that we can help you with your mortgage. All right, so our random city of the day is going to be Aurora, Colorado. We are going to pick a random house that we see online here on Zillow, and one of the first homes we see, it's a beautiful 4-bedroom, 3-bath house that's a little over 2,200 square feet, priced at $580,000. Looks like a pretty nice home. Let's take a look at some of the photos. 3-car garage, got a basketball hoop out front. So if any of you hoopers out there, you've already got a basket that you can try to get some buckets on. Looks like this house is pretty new, and you can see that it looks like probably some laminate flooring there and a pretty nice backyard, pretty decent size. So let's run through some of the specifics of the property. It's been on Zillow for 4 days. It's a new 2-story home located in the Harmony subdivision. So if you're familiar with the Aurora area, you're in the Harmony subdivision. Built in 2021. So again, pretty much a brand new home. 3-car garage, $76 a month HOA fee. Remember, the HOA fee is always included in your debt to income ratio. So make sure that your loan officer is always accounting for this number. This is one thing that can definitely make or break a deal depending on your debt to income ratio. And because of the market that we're in right now, I can almost assure you most loan officers out there are max qualifying you for your mortgage. Now you might say, John, what does that mean? So a max qualification basically means that your loan officer is taking your debt to income ratio to the extreme. Whatever the highest amount that they can still get your loan approved at, that's probably what they're doing. So you want to make sure that they're accounting for property taxes, insurance, HOAs, all these things. If they swing by $100 or more, depending on your debt to income ratio or your DTI, that could certainly disqualify you for the mortgage. Now there's ways to get around that, which I'll talk about today, but it's something you definitely want to be cognizant about when you're having that conversation with your loan officer. And remember, the one thing that we want to get all of you away from when shopping for a lender is asking the question of what's your rate, because you can get the lowest interest rate out there, but if your lender can't close your loan or qualify you for the mortgage, it really doesn't matter. So let's hop back into more of the details of the property. Now here's something that's pretty interesting. Zillow's Zestimate is saying the home value is ranging anywhere from $600,000 to $664,000. Their Zestimate is about $632,000. Now, we all know that the Zestimate is not the end-all be-all when it comes to valuating a property. But as a buyer, in many markets across the country, people are paying over above the listing price or the asking price that the sellers are putting out there on the market. So it's one thing to think about. If you plan on staying in this home for X number of years, even if you overpay for the house today or you're paying above list price, are you going to make that money back? Which more than likely you will at the rate that homes are appreciating these days. But that's why it's super important to make sure that you're working with a real estate agent that does a good job at comping out the property. So that's one of the things that realtors look at when they decide how do we submit this offer to the seller. They should be looking at comparables or comps to see what other homes have sold, what price per square foot are they selling at, and what will your home potentially come in at value. So let's just say in this case, what if the home is $630,000 and we could buy it for $580,000? I mean, shoot, you could offer 20 20, 30,000 above the 580, and you would still technically be walking into some instant equity. So that's why the analysis of the home up front is super important. So make sure you are having that conversation with your real estate agent and you're not just firing off offers blindly, because a lot of clients do that. But what happens is that a few offers will get accepted, they'll start to back out, and then they start to do their homework. So make sure that you truly understand the strategy that your real estate agent is applying to help you get into your home. We have our property taxes here. Looks like it was last assessed in 2020 for a little over $3,000. Obviously, property values are going up, so we know the property taxes have probably increased as well, which will factor that in when we're looking at our numbers. So Zillow right off the bat is giving us a rough number of $3,018 a month for a mortgage payment. So let's just take a look at this and let's just put in our own numbers and update this as we go along. So 580,000, we're just going to do a 20% down payment option for someone that's looking at in a primary residence. So if you are looking at either a vacation home, an investment property, or even a primary residence, make sure to have those conversations with your loan officer, because there are other down payment options that you can look at. So it doesn't always have to be 20%, but for the sake of this video, we're just going to run with a 20% down payment option. Now, I looked at rates this morning. Rates have continuously been going up for the last 30 days. But the one thing I want to bring your attention to is that even though you might be looking at the interest rate and saying 5%, 5.5%, there's no way I'm going to pay that. That's way too high. You have to look at the opportunity of what you are purchasing. Because if you go and you actually Google the 30-year mortgage rate and you look at the history over the last 50 or so years, you will see countless times that the interest rates were actually higher than where we are today. In fact, for some of you that have been watching my channel for a while, you know that I bought my first house. My interest rate was close to 7%, and I still bought the property, and I have a ton of equity in that home today. So if this is your first time that you're looking to buy, don't get hung up on the interest rate. There's a lot of ways that you can look at strategizing how to make this purchase work out in your favor. In fact, I even had a conversation with a loan officer in my branch the other day that showed his clients several loan options where the interest rate on one of the products was higher than what they initially was going to go with. So we actually helped the client understand that the lowest interest rate in that specific scenario was not the best option for them, but that was the only thing that they thought was going to work for them when they came to my specific team member in order to get their mortgage. That's why I always stress strategy is more important than the interest rate. We always want the best interest rate, but you have to remember sometimes that comes with a cost, and that's not always the best option for you. So you want to make sure that your loan officer gives you at least 3 to 4 options when looking at qualifying you for your mortgage. Today, we're looking at about 5.75% with a 720 credit score, again, as a primary residence, and you're looking at paying about 1 discount point. So a discount point is referred to as points in the industry when you look at prepaying to buy your interest rate down to a lower amount. Because interest rates have been climbing up so quickly these days, in most cases, it is going to make sense to buy the rate down because you are going to be living in a home for an extended period of time where you can recoup your costs. So you just need to do a simple break-even analysis if you're deciding on paying points or not paying points, which again, your loan officer should be able to provide you that information. And if they didn't, that's what I'm here for. If you ever want a second opinion, don't forget, you can always send me an email with your loan estimate. We can run through it together and I can certainly give you an honest opinion and let you know if you're getting a great deal or not. So now we're going to take our rate to 5.75%. There is no mortgage insurance because we're putting 20% down. Now remember, one of the biggest myths that are out there is that you have to put 20% down in order to remove your mortgage insurance. Again, another conversation to have with your loan officer. So we know property taxes have probably increased from when they actually built the home. Let's just say 0.75%. Homeowners insurance, $200 a month, and again, our HOA fee. So now with our updated numbers, our total monthly cost is going to be about $33.49. Now, if you can remember when we started these numbers, the interest rate was actually 4.75. So that's another thing to take into account. You've been shopping for a home and it's been 2, 3, 4 months. I would strongly suggest going back to your loan officer and updating your pre-approval. Interest rates have jumped up. Again, look at our simple scenario here from 4.75% to 5.75%. We're jumping up almost $300 a month in payment. Again, depending on how you got qualified, I've seen that happen to other clients where they're buying buying power has dropped because their debt to income ratio has gone up. So there's one way to combat that. You can either put more money down, or you could look at buying your interest rate down even further. Or if it's tough for you to qualify for the mortgage, you might even need to think about getting a cosigner. So there are solutions to the problem, but you have to figure out what is the issue if you're in that situation where interest rates have gone up and now it's hurt your buying power. So now let's take a look at running some numbers to figure out what would you need to earn to qualify for a home of this caliber. We know our monthly payment is $3,349. Again, we use PITI, which again, the acronym is principal, interest, taxes, and insurance. That's the full encompass payment. And for this property, because there's an HOA, we're also going to factor in our HOA. Now, on the credit report, we are going to look at any debts that show up on the credit report. So we're looking for a car payment, we're looking for credit cards, we're looking for student loan debt, and we're looking for any other installment payments that you may have, whether it be, I've seen clients have payday loans, or just a loan that basically you're trying to pay off that you may have borrowed from a private bank or something like that. So let's just say our individual has a car payment of about $500, and with the credit cards, all we're looking at is just the monthly minimum payment on the credit report. Now, you may be paying, let's just say your monthly minimum is $50, but you might be paying $500 a month. The lender is not going to care about what you're paying towards the payment. All we're going to look at is what the minimum payment is on the credit report. So let's just say our buyer, Joe, who's looking to buy this house, his total credit card balance of debt that he pays, let's just say it's $500 a month. Now that's every credit card that he may have. We're going to factor that part in. And student loan debt, Joe has no student loans. If you are in default on any federal loans, you have to get that caught up. So again, make sure you talk with your lender. They can help you point out some of these things that are on your credit report. And that's why it's always important to talk to your lender as soon as you possibly can. Your lender's like a doctor. If you're not feeling good, the doctor has to diagnose you on what is wrong and how do we get you better. Same thing with buying a house. We have to lay out a plan for our clients to be able to cross that finish line successfully, because sometimes you might not be ready to buy a house today. There may be things on your credit. There may be things on your tax returns. There may be money that you're moving around that we can't source, that we need to wait maybe a month, 2 months, 6 months. I've had clients work with us over a year to get things right in order to buy. Don't be ashamed to talk to a lender, because that is our job. Our job is to help you cross the finish line, and we're going to do that with however much time it's going to take us to get there. In this case, we're now going to look at our principal and interest payment plus our car payment plus our credit cards to give us our total monthly revolving debt. That number is going to be $4,349. When a lender looks at qualifying you, they're going to look at two calculations. They're going to look at your front end ratio, which is basically your housing payment divided by your total gross monthly income. And then they're going to look at your total DTI, which is your back end. So the back end includes the housing payment plus the credit cards, the car loan, and all the other debt that shows up on your credit report. So those are two important ratios that your lender is always going to look for. But let's just focus on the back end for now. Our total monthly debt service is $43.49. And again, in most situations, you want to keep your debt to income ratio under 43 to 45%. Now, your lender is going to run an online underwriting decision through Fannie Mae or Freddie Mac. They will then determine whether or not they can get your loan approved, or if there's any red flags that they need to address. But for the sake of this video, let's use the 45% ratio to then figure out how much income do we need to qualify to buy this house. So if we take our total debt service divided by 45%, our total income is now $9,664 in order to buy this house. If we were to figure out what our front end ratio is going to be, all we're simply going to do is just take the housing payment of $33.49. Then we're going to divide that by our monthly income, which would give us a 34% front end over 45% back end, which looks like a really good doable loan. And that's what a lender is going to look at to qualify you for the mortgage. Now, we obviously have some variables here with the credit report, whether it be the car loans, the student loans, any other debt, collections that may be on there. That's why when you talk to a lender, they always want to pull your credit up front. If a lender's not pulling your credit and you're just rattling off some numbers, or they simply just skipped a few steps, you could easily not qualify for the loan. Just because you and let's say your friend make the same amount of money, you folks are most likely going to have different amounts of debt. And the debt is going to be the part that really makes or breaks the loan. Now, again, there's ways to get around that because you could either put more money down, add a cosigner, buy the interest rate down. However, more often than not, lenders and clients are not really having those conversations, especially if you're working with some of these online lenders or you're just doing a simple online application. If no one's actually verifying the information, they're not going to look at some of these options. Therefore, you could easily maybe disqualifying yourself from buying a house when you could truly be buying a home today. That's why it's always important to get with a lender who's going to have these conversations with you, ask you questions. How long do you plan on being in your home? What are the things that really mean the most to you, so they can figure out what's the best loan program to structure to help you get into this property. And that's what we do here at Loan Depot. And that's why I create these videos to help you get your mortgage right. And if you'd like me to run a custom scenario for you, send me an email to my email below and I will put together some numbers for you and we can see how much house can you truly qualify for. And if you have any other questions, comment below, we'll answer them and we'll get back to you as soon as possible. Or we may even shoot a video or feature you as our commenter of the week. My name's Seanu Uyehara and I'll see you on the next video.